Reserve Bank of India has come out with a monetary policy review on 5th of February 2021. Since this follows the union budget which was presented on 1st of February and 2 days before that the economic survey, since it is on the background of these two important policy documents, the monetary policy review of Reserve Bank of India is very interesting. Of course, RBI has been intervening from time to time during the pandemic period with a lot of new initiatives, innovative methods to provide liquidity to the markets and to ensure stability of the financial system. And very interesting that RBI in this edition of the monetary policy review, while keeping the repo rates at 4%, and a reverse repo rate as 3.35%, has brought in new wave of initiatives which will be able to push the growth, and we will be in a position to catch up with the pre-pandemic growth trends much quicker than we anticipated. Based on the RBI survey, the capacity utilization in the manufacturing sector is poised to go up to 63.6% from 47.3%, and the purchasing managers index is also showing an uptick. So the whole economy is in expansion mood, and the GDP growth during 2021 and 22, that is the coming fiscal year, is going to end up somewhere around 10.5%. That's the expectation. It is in sync with the IMF projections. And the economy is going to do much better. It is going to recover much faster because the second wave of virus, there are remote chances of it attacking India. And now that the vaccination is in full swing now in different parts of the country, and not only in India, but we have also helped the other neighboring countries, I think the vaccination program will not only give a lot of confidence, but also the protection to the people. So RBI has brought out many new measures and also taken forward the old measures and given extension as far as the time period is concerned. For example, banks can borrow under marginal standing facility up to 1% against SLR investments. Now that was increased to 3% in October 2020 because of the pandemic. I think the MSF scheme, now banks can avail up to 3% of the SLR investments at 4.25%. So that is a one push to the liquidity which was there which was valid up to March, has been now extended up to October. The TLTRO, that is the targeted long-term repo operations, which was introduced in October 2020, is now extended to NBFCs as well, so that they can lend to the stressed sectors. So NBFCs are also made to join the formal banks so that together they can pump lot of funds in the form of credit, so that the revival takes place very quickly, and banks will be in a better position to lend. The liquidity, the RBI has not only assured that RBI policy will be growth friendly. In one of its most important change that is going to come now, in a bid to normalize the banking operations, the CRR, which was brought down to 3%, is being raised from 3% to 3.5% with effect from March 27. and to 4% from May 22. So it will be brought back to 4%. That is normalization. But at the same time, RBI has extended the 3% banks can draw against the MSF window that was there up to March 2021 has been extended to September 2021. So if we see both these measures, CRR raising and MSF facility being extended, if we see both of them together, I think the CRR hike may not affect the liquidity. Moreover, banking system as such is still in an ample liquidity condition of about 5.97 trillion as on 29th of January. So, we are in abundant liquidity position. One very interesting measure which has been initiated by RBI is banks can exclude from the computation of CRR, that is, the loans which are given to the MSME up to 25 lakhs to new borrowers will be excluded from the purview of CRR. That is, CRR is exempted for new loans given to MSME borrowers of 25 lakhs and below. That means, for lending to small entrepreneurs, banks can exclude from maintaining CRR. So, that is going to add up to the bank's resources, and banks will be encouraged to lend to the new borrowers which were not in the books of the banking system as on 1st January 2021, and the scheme is open up to October 1, 2021. And RBI has also postponed implementation of Basel III till October 2021, which was to be operational from April 2021. So, it has given more time to the banks to add 0.625% of capital conservation buffer to its capital base. So, that will give them more time to recoup their capital position. And the retail investors are given access to subscribe to the government securities online henceforth. So, the retail sector can operate in both primary and secondary government securities market. So, this is the first time that this has happened, that retailers are given access to the government securities market, and it will help retailers to be a part of government securities market. I think with this we become part of select countries which provide this kind of facilities. One is the US, second is the Brazil, and perhaps India is the third country to do so. The check truncation system, that is the image of the check will travel to the bank for interbank settlement of check transactions. This is called CTS, that is check truncation system, whereby the image will travel and not the physical check. This facility was not there hitherto in all the centers in India. From October 2021, this will be made applicable to the pan India. So, all the consumers of the banks will get the facility of quicker realization of outstation checks. So, that is a big facility that is being given, and 24/7 there will be helplines to deal with digital complaints, digital transaction complaints, because many of the consumers who operate the digital mode around the clock, they do not find a way to convey their grievances to the banks. So, henceforth the window of complaints will be available 24/7. So, that is a big facility being given now, and there will be an integrated ombudsman for banks, NBFCs, and also prepaid payment issuers. They will all be having a unified ombudsman. That is, one need not search for whom to convey their grievances. They can come to the centralized grievance redressal system, so that they are in a position to redress their grievances from time to time, and 24/7 digital grievance redressal machinery will also help the banks. So, if we look at the spirit of monetary policy review, it is intended to push growth through banking system and also NBFCs, and an expert committee will also be set up to look into the problems of urban cooperative banks, so that they can also be integrated with the mainstream of the banking system in future, and they can also play their role in financial intermediation. So it is a growth oriented monetary policy review, though the interest rates are kept as it is, and the inflation outlook has also improved now, that it will be within the comfort level of RBI, that is the glide path of inflation, which suggests that the inflation should move between 4% plus or minus 2%, that is the inflation can range between 2% to 6%. So this is valid up to 31st of March 2021. I think after that the government of India will have to relook at the position of glide path, and whether the inflation framework is to be continued or not. I think that the call is to be taken. So looking at all the angles, the monetary policy review is pointing towards faster growth, and all resources are being created, and RBI has assured continuous flow of liquidity to the banking system, so that it is not having any illiquidity problem, and the stance of the monetary policy will continue to be accommodative, not only in this financial year but also through the next financial year, or so long as it is necessary to ensure growth of the economy. All these combined together gives a very clear impression that India is poised for a very faster growth, and it can beat many of its counterparts elsewhere in the world. So till next monetary policy, thank you very much. Please subscribe to the knowledge series, so that we can together learn, and you can put your views on the comment box, and you can interact with me through that mode. Thank you so much.